Alright, and here we are again, now looking at how to secure yourself financially, looking at this financial course and know how to invest and to improve your financial literacy as well from Morningstar. So yeah, so since we have seven models: featured content, stocks, bonds, portfolio, ETF, uh, funds, is something that I already mentioned. Featured content again. So we have here featured content: stocks, fund, portfolio, bonds, ETF, and ESG, the environment governance, or the environment, social, and governance, ESG. So inside of the featured content, I already saw the staying invest in the market. So the importance of staying investment, because after all, stock has provide highest return and increase in the wealth over time by looking at historical data. Also, look at the period of consecutive negative returns and the importance to have a discipline and patience as an investor. Also, that again, looking at historical data, holding on can pay off in the long run. Again, can pay off. It's not a guarantee that after the end of the recession, on average, the cumulative return perceived by small stock outperformed those of the large stock after 1 year, after a month, 6 months, a year, and 3 years after the end of the recession. And also is a little bit of the history of interest rate. What it is, a simple example, in that the Fed tried to achieve or tried to set the target federal fund rate by buying and selling government security in the federal open market. So why is this is important? Because the federal fund rate is one of the mechanisms that the Fed used to control, to regulate the economy. The federal fund rate is the rate at which commercial banks lend each other or fund each other overnight. And this interest rate from the commercial bank, because they don't have the ability to print money out of the thin air, so they ask for short-term loans, and the Fed set a something called discount rate, which is the charge for lending money to commercial banks. This is another mechanism that the Fed used to control the economy. And because in the loanable fund markets, it's also affected, like in the stock market, by the state of the economy. I look at the contraction and expansion in the market. Why? Because, again, analyzing historical data can, especially as investor, if we want to have long-term investments such as retirement, we can make better informed decisions, see how the market performed historically, and know that the risk decrease over time. So by looking at historical data over the past 49 years, since 2021 to 1973, that there have been 10 market contractions, and that in a phase in the stock cycle, and the cycle here is a complete round price, a complete round price stock, a complete round, uh, a complete round price of stock volatility. I think so. A cycle, according to Morningstar, a cycle. Okay. So according to Morningstar, a cycle is a complete round of a stock price fluctuation. And these cycles may vary in length and duration. So a contraction is defined as when the stock market value fall from its peak 10% or more. And the expansion it measures is the recovery or the upswing in price security following a long decline. The term is also used to describe is the upswing or the boom of nation's economic activity. So the expansion measures the recovery of an index, an statistical reference of investment expressed as a percentage in a period of time. The whole idea of the index is to measure progress. So this expansion that measures the recovery of an index from the very bottom of the contraction from its previous peak and the subsequent performance until the next level peak before another 10%. Until it reaches the next level peak until another 10% decline. So the whole idea of this is like, once I look at this historical data, the things to know is that investors should have a long-term investment horizon that allow their investment to grow over time. Again, this is for long-term investors specifically. Okay. After all, we all want to bet to something that give us the fruit of our labor as soon as possible. As soon as possible. And there is some trade-off with that. But in any case, so after I look at the market contraction and expansion, and also the market downturns and recovery, and see that the U.S. equity market, and by equity we mean is, according to Morningstar, is the total asset minus its liabilities, as one definition, the total net of a total net worth of a company, the amount of share you own from a company, that's equity, and ultimately is the total value of a property, okay, or the value of a property minus its lien. So liens is a right to someone else possess your assets until your debt until you repay the debt or you met some obligations. That's another definition of the equity. So the U.S. market or the U.S. equity market has passed through many downturns, and the most severe of that is from the 1929, which started the Great Depression. So when the stock lost over 80% of their value, specifically 83.4% of their value. Imagine that you buy a coffee and then suddenly, okay, you buy a latte, a cappuccino, right, in Starbucks. And imagine that suddenly now you, instead of have full glass, full cup of coffee, you already have just one finger of that. It's like, what the exactly? So the market suddenly lost over 80% of their value, and the recovery period back then was over 12 years. More recently, in the 2000 early, in the early 2000 bear market, the dot-com bubble. So the recovery period lasting 4 years. It was the second longest in history. It's funny because in each one of those uh, downturns, they have a massive implications around the globe. Uh, the most severe downturn it was in 1929, so it ended up having a war, the Second World War, and whatever it comes after, you know. And the dot-com bubble, okay. So things starting to be more directly into particularly technology. So for example, the web or the internet. And in the 2008, when the stock lost 50.9% during the banking and crisis, during the banking and credit crisis, the recovery was over 16 months. Okay, so this downturn lasts 16. Okay, this downturn lasts 16 months, and the stock market recovery after 37 months. That's roughly 3 years, my friend. That's roughly 3 years. So, looking at this market downturns and recovery, it is clear to me that or it is more clear to me that the best thing you can do right now is to start doing things that you know that you should do for yourself. You know, the thing that you need, want, the thing that you need most and want. Okay, so the thing that I need and I must to do is exactly so dedicate time is to learn more about this. At least from Morningstar, and thanks to Morningstar for that. I don't know if I'm going to dedicate my life to this, but I see that this is something important to integrate to my life, to understand much more, not only or small interaction between your friends and your family, but also at large between companies or governments and governments. Uh, so if in those periods, so the recovery, it was the last recovery what it took over 3 years in the 2008. I don't know how long does it take this recession starting from the 2020, and now I am on 2023, right? 3 years has already passed from that. Holy moly! Uh, and that lead me is to the next course, which is the asset class in downturn. So now that I look at the historical data of market contraction and expansions and downturns and recovery, let's going to look at that with respect to the asset class involved, meaning to stocks, bonds, and other classes, along with some sample portfolio structure. Okay, so we will also look at the correlation of different assets with a broader market. Okay, okay. Hmm, okay. Um, so here, what I'm going to see is that the downturns and recovery with respect to the asset class involved, such as stocks, bonds, and other classes, along with some sample portfolios structures. We will also look at the correlation of different assets, stocks, bonds, treasury bill, different assets with a broader market. So it all starts by looking at the bond yield during recessions. Okay, so yeah, so bond yields are driven by factors such as monetary policy, inflation, and loans. Important to understand this because when I look at bond from here, bond, what is a bond? From Investopedia, so a bond can be seen as an IOU between the lender and the borrower. Okay, that includes the detail of the loans and its payment. So this is an IOU between the lender and the borrower that includes the detail of the loan and its payment. Okay. Bonds are used by companies in municipalities. So what is an example of that, you know? Yeah, because after all, Investopedia have a text base. So we don't have any real life experience here when buying and selling bonds. Okay. Because well,
Bonds
ultimately,
are units of debt issued by companies
I
or
am
government
Latin American, man. It's like deal with that. It's like deal with that.
that are converted into tradable assets. Bonds are units of debt issued by companies or governments that are converted into tradable assets.
hmm According to Investopedia, is that so? There are units of debt issued by companies or government that are converted into tradable assets. Okay. Unit of debt, much like the unit of measures, distance, for example, kilometer, or the unit of measure time, second. Okay. The unit of measure weight. Well, you use libras, but I use kilogram. Deal with that. The what is it, that system? No. What is that? What is that system? Uh, kilogram system. Oh my god. It's like oh my, metric system. Exactly. Yeah, metric system. Really. So okay, so bonds are unit of debt issued by companies or governments that are converted into tradable assets. Okay, okay. So much like the unit of measured time, second, or weight, kilogram, or distance, meters. Well, exactly. You don't use for weight kilogram. You use this gram. Okay, they are unit of the debt issued by companies or government that are converted into tradable assets.
Essentially, bonds are used to borrow money.
I barely hear you.
For example, governments use bonds to borrow money to pay for schools, roads, and other infrastructure. War can also create a sudden need for funds. There are basically four primary categories of bonds sold in the markets: corporate bonds issued by companies, municipal bonds issued by states and municipalities, government bonds issued by the U.S. Treasury, and agency bonds issued by government-affiliated organizations such as Fannie Mae. For investors, bonds are thought of as fixed income instruments because they typically pay a fixed interest rate, or coupon
For investors, bonds are fixed income instruments.
rate to bondholders, although bonds with variable interest rates are also common. Most bonds share common characteristics. The issue price is the price at which the bond issuer originally sells the bond. The face value is the amount the bond will be worth.
Okay, now we're looking here as
the issue price is the price at which the bond issuer originally sells the bond. The face value is the amount the bond will be worth at maturity. The coupon rate is the percentage of interest the issuer will pay on the bond.
Wait.
The issue price is the price at which the bond issuer originally sells the bond.
It was the price originally sell. Okay.
The face
The debt. After all, is a unit of debt issued by companies or corporations. Okay.
value is the amount the bond will be worth at maturity. The
What?
originally sells the bond. The face value is the amount the bond will be worth at maturity.
Maturity. Okay, the value when mature.
The coupon rate is the percentage of interest the issuer will pay on the bond. The coupon date is the date on which the issuer will make interest payments.
The coupon date.
Issuer will pay on the bond. The coupon date is the date the percentage of interest the issuer will pay on the bond. The coupon date is the date on which the issuer will make interest payments.
The coupon date in which the issuer will make the payment.
And the maturity date is when the bond matures and the issuer pays the bond's face value.
So this is the anatomy of this. The issue price, the original amount of that issue, the face value, coupon rate, coupon date, maturity date.
The bond market also tends to move inversely with interest rates. So bonds will trade.
Exactly. The bond market
tends to move inversely with interest rate. Bond matures and the issuer pays the bond's face value. The bond market also tends to move inversely with interest rates. So bonds will trade at a discount when interest rates rise and at a higher price when interest rates fall.
Exactly, because it's much more easy to ask for loan. Again, this is part of the loanable fund market, the bond market.
In short, a bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments.
Okay, so an overview of this is that the definition of a bond and what it can be thought of that. The definition of a bond is a unit of debt issued by companies or corporations. Here, it's a unit of debt.
Bonds are units of debt issued by companies or governments that are converted into
tradable assets. Tradable assets. Which tradable assets? You know? Which tradable assets? Bonds and bonds portfolio will rise or fall in value as interest rate change. The sensitivity to change in the interest rate environment is called duration. The use of the term duration in this context can be confusing for new bonds investors because it doesn't refer to the length of the time the bond has before maturity. Instead, duration describes how much a bond price will rise or fall with a change in interest rate. Okay. Categories of bond: corporate bond, municipal bonds, government bonds, agency bond. Variety of bond: zero coupon bonds, convertible bonds, into a tradable asset. And you have types or variety of bonds: zero coupon bonds, convertible bonds, callable bonds, putable bonds. How bonds are priced by the supply of demand in the loan Bond price and interest rate. Another way of illustrating this concept. Okay, this is why the famous statement that a bond's price varied inversely with interest rates work. When the interest rates go up, bonds price fall in order to have the effect of equalizing the interest rate on the bond with prevailing rate, and vice versa. Another way of illustrating this concept is to consider what the yield of our bonds will be giving a price change. Instead of giving an interest rate change, yeah, what the yield of our bond will be given a price change instead of giving an interest rate change. For example, if the price were to go down from 1,000 to 800, then the yield goes up 12.5%. This happens because you're getting the same guarantee 100 on the asset that is worth 800. Conversely, if the bonds go up in price to 1,000, 1,200, the yield shrink to 80.33%. Shrink. But it's funny. You're earning. The yield shrink. Bond price in the market react inversely to a change in interest rate. Yield to maturity. So, to make our life simple, so bonds are unit of debt. The concept from the investor. So bonds are unit of debt issued by corporate or governments for tradable assets that are converted into tradable assets that are converted into tradable assets. So convert, so for example, is when you convert from euro to dollar, dollar to yen, and so on and so forth, right? Okay, so it convert or government that are converted into tradable assets. So you can also thought as bond, or you can think of bonds as an IOU between the lender and the borrower, including all the loans detail and its payment. Okay, so I'm going to get this concept. I'm going to absorb this concept. When someone asks me where do you get that, I'm going to call the source of that. Yeah, Investopedia for that. Okay, cool, cool. So yeah, cool. Bonds yield during recession. So okay, so bonds are this unit of debt issued by corporate, or issued by governments or corporations that are converted into tradable assets. It is also, you can also think of that as an IOU between the lender and the borrower that includes all the loans detail and its payment. Okay, makes sense. So bond yields are driven by factors such as the demand for loans, supply and demand for loans, monetary policy, and interest and inflation. So the Fed has, or the Fed used the federal fund rate and the discount rate as it is primary tool to implement monetary policy. So what happened is that during a recession, the demand for loans fall and the Fed, exactly, during a recession, the demand for loans fall and the Fed lower their interest rate to stimulate consumer spending. And during an expansion, the Fed want to make, the Fed may want to keep inflation in check and tightening monetary policy by increasing the interest rate, which is exactly what happened here and why the Feds are so driven to do this. So once you understand this, and this is something that also Picasso mentioned, right? So on this, so know the rules so you can break it, and beware with that. Beware with that. Beware with how do you want to break that rule. But the whole idea here is to understand is how this works. You can align with that, and when someone more professional or dedicated to this field, a connoisseur in this field, so you can have a debate based on source that you already learned. Morningstar, Investopedia, and so on. Okay, makes sense. Makes sense. So yeah, so it's just explaining is that, right? So the Fed used the federal fund rates and the discount rates as it is primary tools to implement monetary policy, aka regulate the economy. So during a recession, the demand for loans fall and the Fed lower the interest rates to stimulate consumer spending. But during an expansion, which might happen this perhaps at April, who knows? But during an expansion, the Fed want to keep the Fed wants to keep inflation in check and tightening monetary policy by increasing the interest rate. So this short-term interest rate, like Treasury bill, have a close correlation of the federal fund rate, which the Fed target through the open market operations. So they buy and sell government security in the federal open market. So short-term rates has been more volatile according to this graph. So short-term rate has been more volatile, whereas loan rates, which have a maturity of 10 to 30 years, 20 to 30 years, has been relatively stable and have taken longer to react to economic change. And this is looking at the bond yields during recession. You know, the entire narrative of what happened there. Okay. So how bonds rates are affected by inflation. Bond yield, especially long-term bonds yields, are sensitive to inflation expectation because inflation can erode the value of the bond. So, after all, since a bond is a unit of debt issued by the corporate company, corporate or government, so if they issue that debt to you, bonds, and the bonds holder, in my case here, they are very sensitive. So I ask them for a loan or a bond, okay, and they are sensitive to inflation expectation because inflations can erode the value of the bond over time. If inflation expectations are high, meaning that you will have to pay less, allegedly, exactly, meaning that you as a bondholder have to pay less. Lenders require a higher interest rate. Exactly. Lenders, in this case, you need to assume that it's the Fed. Lenders require a higher interest rate to let funds for more than the short term. Exactly. So the lenders say, hey, you know what? Because the inflation is the expectation of inflation are high. Well, I'm going to increase the interest rates to lend fund for more than the short term. Therefore, if inflation expectations remain high, one thing is if inflation expectations are high, and the other is remain high, long-term interest rates may take longer to drop. Even during period when the Fed is cutting rates, in the long run, interest rate could even rise instead of fall. So there has been a general decline of rates since the recession in 1982. Although interest rates have generally dropped during recession and rising during expansion, and there have been a general decline of rates since the recession in 1982. And when we talk about declining rates here, there has been a general decline of rates since the recession in 1982 for these long-term and short-term government bonds. Okay. Therefore, if inflation expectations remain high, so although interest rate has generally dropped during recession, and if the interest rate drop, the value of the bond increase. Again, this might not be apparent to repeat, but the whole idea is to see that over time, bond yields or the no, the according to the U.S. because this is U.S. data. This is U.S. data. So since inflation rates drop or since interest rates drop, since interest rates drop, the demand for bond increase. The demand for loans increase, and with that is well, people wants to take new adventures of that. So give them opportunity to make some entrepreneurial whatever, you know. Okay, 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 my guy. Okay, my friend. Okay, okay, okay. Mm-hmm. Okay. Give me a second here. Taka, pues, se va a mitad. Mm-mm. Okay. Okay. Uh, okay. Making a reading of this. Although interest rates have generally dropped during recession and rising during expansion, there has been a general decline of rates since the recession in 1982. In the recession of 1982, it was caused by the Yom Kippur. I will say that it started by the Yom Kippur War. Mhm. Start by the Yom Kippur War, since the U.S. backed Israel forces and they dropped. Yeah, since the U.S. Support Israel forces and the Petromonarchy didn't like that. The Petromonarchy didn't like the names. Okay, the U.S. Here I'm playing devil advocates from the U.S., Israel, the Petromonarchies. Yeah. So oil price shock. Exactly. Prior to that, interest rates were driven up because of the oil price shock of the 1970s as the Fed aggressively pursued this strategy to lower inflation. What makes you think exactly? Historically, the Fed aggressively pursued a strategy to lower inflation by increasing the interest rates to holy fuck, to 14% for long-term government bonds, into 50%, 70% interest rates. Holy fuck me. Exactly. So after they bring a lot of money for that, uh, they just want us to keep inflation at check by tightening the monetary policy. How? Increasing the interest rate. And again, this is the mechanism that the Fed has to regulate or control the economy. Right? You have the federal fund rate and the discount rate, as it is primary tool to implement monetary policy. And most governments follow that formula. Most governments follow that formula. Okay. Okay. Okay, Marcus. Alright. So keep in mind that bond yields are and price moving opposite direction. Exactly. Keep in mind that bond yields and price moving opposite direction. When yields for new bonds fall, when yields for new bonds fall, existing bonds with higher yields become more valuable. They can demand a higher price. Okay, when yields for new bonds fall, conversely, when yields for new bonds rise, the price of existing bonds fall in order to compete with the increased demand for new bonds. Okay, I'm going to wrap up. Yeah, I'm going to leave like that. Uh, it has been very, very illustrative. So yeah, take care. Bye bye.